Extending credit to customers can help increase sales, but it also comes with risk. No matter how carefully a business evaluates its customers, some will inevitably be unable or unwilling to pay what they owe. As a result, businesses must estimate these future losses so their financial statements present a fair and accurate picture of their financial position. That's where the allowance for uncollectible accounts come into play. Rather than waiting until a customer actually fails to pay, accountants estimate bad debt expense in advance to comply with the matching principle and present accounts receivable at its expected collectible amount. In this video, you'll learn why uncollectible accounts occur, how businesses balance the benefits and risks of extending credit, and how accountants estimate and record bad debt expense using the allowance method. So what are uncollectible accounts? Simply put, uncollectible accounts are debts that the business thinks it may not collect. For instance, you've sold goods or services to a customer on credit, but now the customer can't or won't pay. Why does this happen? Well, sometimes customers go bankrupt, or there is a larger economic downturn, or another reason might be that the business is not managing the credit risk wisely and is extending credit to customers who won't pay. Sometimes it's because the customer's financial situation takes a turn for the worse, or there is perhaps an unresolved dispute over the goods or services that were delivered. The company believes that they delivered goods as promised, but the customer doesn't agree and won't pay the bill. It could also be fraud. The key takeaway here is that the uncollectible accounts are often beyond our control, but we need a plan for them. So what do we do when we know we might not get paid? Act here that every business has to consider. On the one hand, offering credit can lead to sales growth. And if you don't give credit, you might miss out on customers who don't have the cash up front. But here's the catch. The more credit you extend, the greater the risk of not getting paid. So it's all about finding a balance, offering enough credit to drive sales without exposing yourself to too much risk. Imagine a business trying to grow its customer base, but also not wanting to get burned by risky customers. How do we navigate this? Well, that's where credit policies come into play. Once the debt is outstanding, it's all about managing the collection process. First, communication is key. You need to keep customers informed about what they owe and when. If payments aren't made on time, it's best to contact the customer early on and remind them before it becomes a bigger problem. One company I worked for a few years back had a process where they contacted the customer by email a few days after the invoice was sent, just to check that they had everything they needed to pay the invoice when it was due. That process worked well for them, and customers basically committed to paying on time. You should have an escalation process, though, because you don't want to jump straight into collections too soon. But you also need to have a clear path if things get out of hand. Oh, and here's a tip that might produce faster customer payments. Offer early payment discounts. A little incentive goes a long way in getting people to pay faster. Most accounting ERP systems have an accounts receivable note section where the person who's contacting the customer keeps a record of the date of contact, discussion notes, and results. I like the electronic notes and the ability to put the customer account on hold in the ERP or CRM, with the authorized employees being able to see the notes related to the customers, as well as so that everyone is informed and on the same page. So what role do accountants play in all of this? A big one. Accountants need to assess credit risk before extending credit. This means reviewing a customer's credit history to understand how risky they are. Credit policies differ from one company to the next one and one industry to another. However, what is typical is a credit application, a request for a copy of financial statements, and perhaps a credit check with companies like Dun & Bradstreet. You may even contact some of the references the customer is providing. Based on that, you should set a credit limit, but continue to monitor the customer for prompt payment. And be cautious. I've seen my share of customer accounts where the customer received a credit limit and quickly ordered up to the max of the limit and then did not pay the invoices. Accountants also need to be proactive in setting up a reserve for bad debts. The most common approach is the allowance method. This means you estimate the amount of debt that's likely to go uncollected even before the customer's default. One way to estimate this is by using the aging method. Here you categorize outstanding accounts by how long they've been overdue, and then apply a percentage of likelihood that each category will turn into bad debt. For example, accounts that are just 30 days overdue may have a lower likelihood of being uncollected than accounts overdue by 90 days. Based on this, you can set aside a reserve for bad debts accordingly. The important part is to adjust the allowance account regularly, as more overdue accounts might accumulate, and you might need to make changes to your estimation. This is essential for making sure your financial statements reflect a true picture of your company's assets. Let's look at an example. In this example, Samsung Company had net credit sales of $960,000. And experience shows that 0.5% of the firm's net credit sales result in uncollectible accounts. Our calculation for our reserve for uncollectible accounts would be the amount of the credit sales, $960,000, times the percent that is deemed uncollectible, in this case, 0.5%. So we end up with $4,800 in reserves for uncollectible accounts. We'd record the journal entry by debiting the uncollectible accounts expense for $4,800 and crediting the allowance for doubtful accounts for $4,800. The uncollectible accounts expense is an income statement account, and the allowance for doubtful accounts is a contra asset account on the balance sheet. Accounts use a contra asset account when they still want to see the full balance, in this case the accounts receivable account, but also want to see how much is deemed not collectible. Here's another example that's a little bit more complicated. Samsung Company has total accounts receivable as of 12/31/2025 of $1,512,698. And here we have a listing of the aging categories for this amount, and most of it is between 0 and 30 days past due. You will get this information from the accounting system by running the AR aging report. The company's allowance policy is to record a reserve for uncollectible accounts of 50% for accounts that are 61 to 90 days past due and 100% for accounts that are 91 days or older. This is just an example. In my experience, many companies only reserve 100% on accounts that are over 90 days past due, whereas others reserve 100% on accounts that are over 60 days past due. In our example here, the calculation for the reserve consists of multiplying the first 61 to 90 days receivable by 50%, and then the over 90-day receivables by 100% for a grand total of $50,293.50, which we record as a reserve for uncollectible accounts by debiting the uncollectible accounts expense and crediting the allowance for doubtful accounts for $50,293.50. The bottom line is that managing uncollectible accounts isn't just about avoiding bad debts. It's about protecting your business's financial health and cash flow. If your uncollected debts start piling up, it can seriously affect your ability to operate, pay bills, and make payroll. But you also have to consider your customer relationships. A fair, well-communicated credit policy will build trust with your customers. And your policy should always align with your business goals. If your goal is aggressive growth, your credit policy might be a little bit more lenient. If you're looking to protect your margins, you might tighten things up. There's no one-size-fits-all policy, and that's why it's so important to constantly evaluate your strategy. As you've seen, extending credit can increase sales, but it also creates the risk that some customers won't pay. Rather than waiting until an account becomes uncollectible, accountants estimate these losses in advance so that expenses are recognized in the same period as the related sales. By using the allowance method, businesses present accounts receivable at its estimated collectible value and provide more accurate financial statements. This approach is another example of how the matching principle helps ensure that the financial statements tell the true financial story of the business.